Hi everyone, my name is Loutsenko, founder and CEO of OVOM Research. I just wanted to do a two-part video, just because uh, a lot has been going on with the equity market and from my perspective, the global macro stories. So I just wanted to touch on on those two things quickly, and uh, besides that, hope everyone's having a great weekend. Um, I I decided to go a little more casual in a sweater, but anyway, let me get to the presentation. Sorry about. Okay. Okay. Like I said, I wanted to start with the U.S. equity market and then transition into my thoughts on some recent updates with global macro. Um, Starting with the US equity market, I've heard a lot of talk in mainstream financial media and places like that the concentration we're witnessing in the largest mega caps is um you know not necessarily something to worry about. And I guess I wanted to show a couple research slides that I prepared to share why I don't think that's the case, and certainly historically. So I think this is one of the most important charts of the presentation. So this chart shows the top 10 stocks relative to the total US market cap. And it's over 100 years old. It's from, I believe, 1920, almost 100 years old, from 1925. So we could actually see that the current level of the top 10 mega caps relative to the total US stock market has surpassed the 2000s tech bust peak. And the only point of reference we have for how that dynamic could ultimately end is unfortunately the Great Depression. So I'll get to more of why I think that this is an unsustainable dynamic, but I just wanted to start by showing from a historic perspective that these kind of uh, very, very over concentrated market leadership cycles tend to end very disappointingly for market participants. So go to the next slide. So this is something I've shared numerous times. It's just the uh, uh, CAPE ratio, so the cyclically adjusted price to earnings ratio, which factors in inflation. And that's a reason I like to use it more than just the standard PE. So you could see today the current level is 32.61, which historically dating back to 1871. That's very elevated relative to history, and in fact, it is above the peak preceding the Great Depression. And you can see what kind of catastrophic deflation we saw there um, in equity market asset prices. And just as a rule of thumb, 30 is considered very historically expensive, and 10 is truly cheap. but yeah, I have some more slides that kind of show why I think the market's overvalued using maybe more um, unique metrics, but this is a very popular one, and um, from this metric, the market, few would argue that the market's fairly priced here. So this is actually another one of my current favorite slides. So the red bars represent the number of S&P 500 components underperforming the S&P 500 composite. And what we see is really today's levels haven't been seen since the early 90s tech, sorry, the early 2000s tech bust. And we're only 6.5 months through 2024. And, with the kind of market leadership we've seen, it's really the S&P 500 composite is frankly carried by semis. So I wouldn't be surprised to see, um, by the deeper we get into 2024, you know, we may even break the late 90s records in terms of this metric of concentration. So just one more metric of, well, sorry, I actually wanted to talk about small caps briefly here. So, small caps give us a much better idea of where the economic reality is from an equity market perspective. I've talked about this a lot before. Large caps have the advantages of economies of scale, and they're starting to do a lot more of what we've seen recently, namely layoffs to try to maintain profit margins. But small caps don't have that luxury. They don't have the juicy AI story. And right now, the ratio of the ratio of small caps to large caps is at its lowest since the second quarter of 2021. So, over 22 years since large caps performed at, an equal level on a relative basis to large caps. And again, that's not necessarily a signal of market leadership, but that, to me is a signal of a weakening economy for sure. I guess just one more quick chart in with respect to market concentrations. So, I know Apple, since the chart was made a few days ago, Apple's rallied, Microsoft's rallied, but still, when we talk about the Magnificent Seven, which I'll get to in the next slide, in a little bit more detailed way, it really is, again, just from my perspective, and hopefully the data will show this later. It is a NVIDIA semi AI story more so than even the Magnificent Seven mega caps who have some footprint in AI. And just once again, that kind of razor thin market leadership has never worked out in the benefit of investors who went who took out a very long position. So this is what I was talking about, the contributions to S&P 500 24 year-to-date returns for the excuse me, market weighted composite, S&P 500 market weighting composite. It's interesting, sorry, a few things interesting here. So the Magnificent Seven combined account for almost 2/3 of the contribution gained by the other 493 components. Even more alarmingly, NVIDIA alone contributed more than the other six of the Magnificent Seven to the S&P 500 year-to-date contributions. So, when some people, make the argument this is the NVIDIA's AI semi market, it it's hard to look at data and tell them they're wrong. So I just wanted to dive into valuations for a couple of slides. So again, I've heard a lot of talk about um, how mega caps actually in particular are fairly priced to the rest of the market. And again, the quantitative data, the quantitative data shows that's simply not true. So here we see a grouping into ranks based on market cap. So 1 to 50 is the top 50 equities by market cap in the S&P 500, whereas 451 to 500 is the lowest. And what we actually find is that the median price to sales ratio for top 50 S&P 500 companies by market cap is 3 times higher than the lowest 50 in the S&P 500. So, this suggests that from the lowest to the highest market cap, investors are paying 3.5x price sales per share. So that's it could go both ways depending on the growth rates and obviously a lot of fundamental uh, performance. However, really, I just wanted to include this chart to somewhat debunk the notion that the largest mega caps are a good buy because they're also the most cheapest. So this is actually one of my favorite slides of the whole presentation. A different kind of valuation metric that also kind of speaks a little bit to market concentration. So every 5 years, these are the 12-month forward price to earnings ratios. The red's the top 10 mega caps of each 5-year period. The orange is the uh, remaining 490, excluding the top 10. And then the blue is the S&P 500 composite. So, you could see pretty much every year listed here, with the exception of 2000, which was, a bit pricey. Even more so with 2020 and 2024 year to date. As the heading of the chart indicates, and you can see the data. Today's market is matter of factly more expensive, at least on a 12-month forward price earnings ratio metric than it was entering the early 2000s. So, something to think about there for sure. So before I get to hopefully, pretty quickly closing out the kind of the macro component I had to add, I thought this would be one more interesting kind of, year-to-date performance metric to show, and this specific to the semiconductor, tech AI stocks that we would be expecting to see, all the enthusiasm for. And I believe this was made about a week ago. So some of these names have been, saw a bit of a pop, but as of a week ago, you could see really, really household AI names. Adobe almost 24%, Etsy 22%, Cisco 7%, Tesla climbed up a little, but they were down almost 30%. Intel climbed a little, but they were doing disastrous. Even Salesforce, here they had that decline because of the um, revenue disappointment, their last earnings call. But still, again, Broadcom moved up pretty pretty significantly in the last week. But all in all, here I wanted to say that while you definitely do have the semi AI stocks that are continuing to propel the market forward along with NVIDIA, you're seeing in reality fading market leadership from some of the key AI names who would be expected to drive that market forward. So in a way, it's at least I view it as even further narrowing market leadership. Oh, actually, sorry, I have a couple more slides on fundamentals. So, for those who follow the equity market, not necessarily from a macro perspective, but also from a fundamental perspective, typically when fundamentals begin to deteriorate in the equity market, you'll see revenues lead earnings, and no, that's basically what the chart is illustrating. And again, that has a lot to do with economies of scale, being able to lay off employees, cut costs, all that kind of stuff to maintain earnings. But with respect to revenue, if the economy's weak, if sales are weak, there's not. Of course, there's things that can be done, but in the grand scheme of things, revenues will be the first to suffer. And again, I believe we're seeing that. So this is another really interesting chart that I wanted to show. For those who have been following S&P 500 earnings, for the last 6 quarters, the S&P 500 has literally been flat, and with I believe 4 to 6 year-over-year EPS declines. The Russell 2000, the last 6 quarters have been negative EPS growth. So I thought it was very, very interesting that the market's pricing in the light blues, the small caps, almost 25% EPS growth a year from now in 2Q 2025. And, bear in mind, I'm going to get to this part last. Bear in mind, we're in a higher for longer rates environment, and small caps, as the historical EPS, reports have shown, they're highly sensitive to interest rates, and the longer they remain higher, the less wiggle room they have. So I think the chart does a good job of really accentuating the point that earnings estimates are, at least in my view, going to be revised substantially lower in the coming quarters. And this is just a chart to kind of back that up in the most recent quarters. So 64 companies showed negative guidance, which is above the 5 and 10 year averages. Really not saying a whole lot. Based on the quarter, companies may have reasons to issue or not issue guidance, but I thought it was fitting to add given the last slide. So before I get into the macro part, which I hope to finish quickly. I thought this was an interesting chart to share because it gives a lot of insight into what could happen when there is, a market buildup that's not grounded in valuations at all, but exclusively sentiment driven. So this ratio is of the Philadelphia Semiconductor Index, the S&P 500. And as you could see, directly preceding the tech bust, when quote unquote semis like Cisco and companies you guys have probably forgotten, like Lumen Technologies. There was AOL. Anyway, a lot of companies that went bust because the market does certainly trade on sentiment first and foremost, but at the end of the day, it's rooted in valuation. So again, you could really see just how hard semis crashed. When investors became especially paid a special attention to earnings, which obviously isn't the environment that we have today. But equity valuations are grounded in earnings. So, I certainly think we'll get back to that point sooner rather than later. And unfortunately, that might leave some semiconductor investors in particular who, might have FOMO and went for really, really exuberant valuations disappointed. So finishing up with the macro part, like I said, I always like to start with the slide because it's a great visual representation of the core concepts of how macroeconomics helps you get ahead in the U.S. equity market. So without going through the calculation I used here, the purple line, the dark purple line is ISM prices paid, and the lighter line is the 30-year yields with a 24-month base support rate of change in its year lag. So just to kind of give a one sentence summary of what the chart shows. So when interest rates get hiked, or cut in a very dramatic way, that impacts the business cycle after a period of lag. So in this chart, you can see both when interest rates were raised, prices paid came down. You have to remember that the 30-year yield here is inverted, and vice versa. When rates came up, when rates came down, prices paid went up. So, and just to finish here, as it relates to the equity market, higher interest rates mean lower prices paid. Lower prices paid, ultimately signals a weak economy, which means lower EPS scores for the equity market. This is just a quick chart showing how hiking the federal funds rate at in very quick succession, again, after a period of lag, leads to labor market deterioration. And in this case, year-over-year jobless claims. Jobless claims have been lagging, but interestingly, in the last 2 weeks, they've spiked, so to speak, only because we're dealing with a labor market shortage. But if you factor that in, they're actually getting very, very close to the minimum historic end of recession standards. So something to keep an eye This is another chart of the U.S. unemployment rate, and what the chart shows is, labor markets are cyclical, and if you see every single red uh, circle here, you'll see that every time the U.S. unemployment rate crossed the 24-month moving average, it immediately led to labor market deterioration and recession. So you see here, 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 here. So every time that literally it's crossed in the last 60 plus years, it's resulted in almost immediate and a recession in the next couple months. So here, this was actually moved up to 4.0 in the last reading, so we are getting very, very close. And so the last part of the presentation, I just wanted to kind of present some potential other opportunities given the issues that I see with the equity market and actually other financial assets, which I have in the last couple slides of the video. But what I wanted to highlight is that I know a lot of people are, kind of glued to the 60-40 portfolio or, the 90-10 portfolio, 90% equities and 10% cash. But, this is the 24 year-to-date performance. I believe it's through May 25th, so a little less than a month ago. But we know that U.S. Treasuries and the U.S. bond market is in a bear market, and you know uh, a lot of that's actually why a lot of companies that I've heard, hedge funds and things of that nature that I've heard of have switched to 90-10 portfolios. But regardless, you could see like the equal weight S&P 500 in 2024. It's dramatically underperforming gold miners, silver, emerging markets. The S&P 500's underperforming gold and gold miners. And I guess one last thing I wanted to point out here before I actually have one more slide to finish talking about at the end. I still believe that broader commodities have a lot of room to move upward. And so without further ado, this is, I've went over this before, so I'll just hopefully take no more than 5 minutes. So since surge inflation hit in 2021 and the Fed mistook it for transitory inflation, I've been pretty partial to a precious metals and commodity super cycle. And this is where it starts from, a triple threat of economic conditions that, at least historically, and I think even more so in this current macro environment, set the stage for what could be a real tangible a real tangible assets super cycle. So first we have the inflation, that's similar to the 1970s sort of inflation. So far, we've only had the first wave. We have a public debt crisis that actually outpaces the peak reached in the 1940s. And then, as I discussed, we have equity market financial valuations at really unreasonable levels. So beyond that, from my perspective, this is a critical chart to why I believe the bull case for precious metals kicked off. So as I'll briefly show in the last slide, for a very long time, treasuries and golds are both considered safe haven assets. that was the whole purpose of the 60/40 portfolio minus, the gold. If something happens to risk assets and equities, investors would have, great risk management with gold. With treasuries. But since, this Fed's hiking campaign, um, treasuries have been in actually, I believe it's the most severe bull market in bear market in their history. So treasuries are no longer viewed as, the same asset they were, for example, in '08. And I think that gives gold, tangible metals, and commodities a very, very big boost, especially in the mid to long term. And this is exactly what I was talking about. So here you see the correlation, and then here's the bear market, beginning for treasuries, which causes a breakout in gold. And that's actually, definitely not the number one thing causing the breakout now. From my perspective, it's the large buying by central banks, but I'll leave that for another video. And so as a result of, what I've discussed, we've seen gold hit record highs in 8 different of the most major currencies in the world, including USD, the latest. And I wanted to, I believe this is my second to last slide. It's one of the last. But I wanted to show this one because, the breakout in 2024 looks similar to 79 in 2007. But I wanted to talk about it a little bit because if you think about 74 and '07, they were very, very different macro backdrops. So one was a stagflationary environment. The other one was a severe deflationary environment that led to a global financial crisis, which involved obviously the severe devaluation of financial assets. And that just, to me at least, it goes to prove that in any circumstances, and this isn't just those two times, but even before in history, when excuse me, when financial assets weren't doing well, gold outperformed any other, asset class at the time. And whether, some people think we might be headed for stagflation, sooner rather than later. Personally, I think we'll see a deflationary recession first, and when the federal government needs to be bailed out, I think we'll possibly see a reacceleration of inflation. But in any case, both scenarios are historically very bullish for gold. And this is actually a few slides I put together, bearing in mind that I am bullish on gold and precious metals. I think there's some specific parts of the market that are currently undervalued, even relative to gold. So as you could see in previous precious metal cycles, silver greatly outperformed gold and still lagging. And the same thing with miners. So, gold miners and junior miners are lagging the spot price of gold on a relative basis, and silver miners are lagging gold miners on a relative basis. So I think those areas have a lot of room for upside in the coming years. And sorry, one more thing that I wanted to touch on before, sorry, the final two slides touch on kind of one of my main points that I wasn't sure where to bring up, but so I know we all remember 2022, and with the really really brutal bear market in U.S. equities and bear market um, for fixed income given Fed's hiking cycle. So my takeaway from this chart is that portfolio managers and again other asset allocators are under a lot of pressure to ensure that 2022 doesn't happen again because as this chart shows, it was the worst performing year for the 60/40 portfolio since the Great Depression. So my sense is that, and this is supported by a lot of data that I didn't include here. My sense is, portfolio managers are kind of chasing a backwards dream with respect to the Magnificent Seven. And there's, very, very little room for upside there that hasn't been priced in, if any. And, it's definitely a topic for another video, but I sincerely believe that, you know, outside of the Magnificent Seven, a lot of S&P 500 names are still pretty significantly overpriced. So the bottom line here is I think that, if we do see a bear market, it could even get worse because, like I said, a lot of investors are chasing what's now a backwards looking dream since all the growth is priced in. And this just really, excuse me, this just really doubles down on what I said in the previous slides. So if you look at the family office global asset allocation percentage coverage, and this from UBS, a combined 2% of that of global asset allocation percentage is in commodities and gold and precious metals, where is where you have something on the order of almost 30% for equities, almost 20% for fixed income, uh, 10% for real estate, which historically is understandable, but at the same time, we talked about gold being a safe haven asset. Sorry, we talked about treasuries being a safe haven asset. Real estate's historically been a safe haven asset to protect against inflation, but given all the kind of backlash from COVID, obviously there are a lot of real estate loans in jeopardy in this year, but also in the coming years ahead. So we could even see some of that percentage transitioning to gold and precious metals when when we see more broad interest from like I said, a variety of market participants, and we really don't think that's out of the question at all. No, and again, the primary reason being that financial markets are in a world of pain, and at this point, the Fed really has, short of a miracle, and an unbelievable outlier exception to history. Even the Fed, at this point, there's nothing the Fed could do to stop what I view as the inevitable. Okay, thanks so much for watching. Hope you enjoyed, and feel free to ask me any comments or questions. Always happy to talk markets, and happy weekend. Thanks again.